I thought the company Vale looked really interesting because they're paying a very high dividend, and also their PE ratio is only about 5 right now. So I've been digging into this company to see if it might be worth picking up some shares here at this price. It trades on the New York Stock Exchange under the ticker VALE, and today it's at $9.17 per share. When looking at their dividend history over the last 5 years, the company has paid $6.83 per share in dividends. And if you take this amount, the average paid during the last 5 years, divided by the share price, you get an annual yield of approximately 14.9%. And this annual yield doesn't even include the return to shareholders by way of buybacks. The company's also reduced their share count quite a bit during those 5 years as well. In 2020, the total number of Vale shares outstanding was 5.13 billion, and today the share count sits at about 4.27 billion. So the company has reduced their share count by almost 20%, while during that time period paying $6.83 per share in dividends. Now, it's pretty rare to see a company buying back shares this fast while paying dividends like this. So that's what intrigued me to look into Vale today. If you look at Vale's revenue by business segment, the vast majority of the revenue comes from iron ore. Right now it's about 82% from iron ore, 12% from nickel, and 6% from copper. So by far the most important thing when it comes to how much Vale can pay in dividends is the price of iron ore, because their production from year to year is pretty steady, so it's the price of iron ore that matters the most. Now I want to go back a few years and show you their numbers from 2021, because we had higher iron ore prices in 2021. So I want to show you this as an example of what Vale could potentially pay in dividends or in share buybacks in a good year going forward. So in 2021, Vale bought back $5.2 billion worth of shares, and they paid dividends of about $13.1 billion for a total return to shareholders of over $18.3 billion. But since then, since this date, they've reduced their share count a lot. So if iron ore prices were to go back up to where they were in 2021, and they had this much to pay out in dividends, when you split it amongst fewer shares outstanding, your dividends per share, or your return to shareholders per share, is going to be higher. So if iron ore prices got back to where they were in 2021, we might see Vale having about $18.3 billion to pay out to shareholders. When you divide that number by 4.27 billion shares, you get a return to shareholders of $4.29 per share. Based on today's stock price of $9.17, that's a potential annual yield of 46.7%. So that's just to give you an idea of what we could possibly see in the future by buying Vale shares today at this price. Now I give this example from 2021, not to say that we should expect this, but just kind of to look at our upside scenario, because if iron ore prices were to revert back to the prices we saw then, which weren't totally unreasonable, like they weren't extraordinarily high, but they were much higher than they are now. So I think that it's a real possibility that in future years, although it's going to vary a lot, there's the possibility of having about $18 billion to return to shareholders. Something else I thought was interesting was that their earnings per share, their total earnings per share over the last 5 years was $13.21. So in the last 5 years, the company has had more earnings per share, significantly more than today's stock price. So if we could see things like this going forward, there's potential to see really good returns from Vale. Right now, iron ore prices have normalized from their high levels. They could certainly go lower, but they have room to go higher as well. And in the trailing 12 months, Vale's operating income was $12.7 billion. And over the coming years, They should be increasing iron ore production a little bit from about 328 million tons per year to about 360 million tons. And also during that time frame, they say their average iron ore produced is going to go up a little bit. Right now it's somewhere around 62.5%, and they think that it's going to go up to 63 to 64% by 2030. And the higher the iron ore content, the better price you can get for your iron ore. So their iron ore production should be increasing a little bit, and also they should be able to get a higher price for the iron ore that they're producing. And then their copper production is going to change quite a bit. In 2024, it was about 345,000 tons, and by 2030, they think they can increase it to 460,000 tons. So that's a pretty significant increase. But if you remember, copper right now is only 6% of their current revenue. So even if they increase their copper production by a third, let's say, it's still going to be a pretty small portion of the company's total revenue. So we've seen that Vale has the potential to make a lot of money, but now let's look at their debt. So right now their net debt, which is total debt minus their cash and cash equivalents, is $11.9 billion. And in the last 12 months, they've had a net interest expense of $900 million. However, back in 2015, Vale had this tailings dam collapse, and it was a gigantic environmental disaster that killed a bunch of people. And recently, they settled a court case, or they reached a settlement in Brazil for this Mariana disaster. And so now we know the payments that Vale is going to have to pay coming up over the years. For some of these payments, they're planning to add this to their net debt. They're planning to take on additional debt, about $7.1 billion in additional net debt for these Mariana-related expenses. So that could bring the net debt up to about $19 billion. And if the net debt increases to $19 billion, what would the new net interest expense be per year? We might be looking at about $1.5 billion per year in net interest expense. This still looks relatively small compared to this trailing 12 months operating income of $12.7 billion. But now let's look at some other expenses. If we look at Vale's big expenses and compare it to their operating income in the trailing 12 months, well, you might see that this operating income no longer looks great, at least in 2025. So the company pays about $6 billion in dividends annually. It varies, it goes up and down, but it's been pretty steady around $6 billion for the last several years. In 2025, they're planning to spend $6.5 billion on CapEx. I showed you that growth they're going to have in their iron ore production and in their copper production. Well, that doesn't come cheap. They have to invest a lot of money in CapEx to both maintain production and to grow production. And in 2025, their liabilities from their Mariana settlement are about $3.7 billion. Their 2025 net interest expense might be about $1.2 billion. Right now it's at about $900 million, but they're going to add to their net debt. Now, I don't think it's going to go all the way up to that $1.5 billion number that I was talking about just a little bit ago in 2025. We'll probably see that in 2026 or so. And then the trailing 12 months of income tax is $1.6 billion. So you total all these up and you're looking at $19 billion with about $12.7 billion to pay that if their operating income going forward stays at this level. So that tells me they're going to have to cut back somewhere here, but they can't cut back here, and they really want to spend that CapEx, so they're probably not going to cut back here. They can't cut back their net interest expense, and they still have to continue paying income taxes. So where can they cut back if they have to cut back their spending? They have to cut back their dividends. At least that's what it looks like to me. So I think in 2025, their dividends are going to suffer a lot. Now, going forward into 2026, their CapEx will probably remain about the same. Their Mariana liabilities goes down to something like, what is it? I have the number here. It goes from $3.7 billion to 2.6 billion. And then in the coming years, in 2027, it's down to 1.6 billion. And then in 2028, it's down to 1.3 billion. And then in the years following that, their Mariana liabilities are less than $1 billion. So it drops off pretty fast after 2026 because this recent settlement that they had in Brazil, it weighted most of the payments towards the early years so the victims could be compensated sooner. So that's why they did it like that. But I don't love these numbers for 2025 that I'm looking at here. And if we look forward to 2026, if iron ore prices stay about where they're at right now, I don't love the numbers for 2026 either. And in 2026, I think they're going to have to cut back on their dividend payments too. So I think these next 2 years aren't going to be great for dividend payments. That doesn't necessarily rule this out as a good investment because, for example, if you can buy the stock for about $9 today and then the iron ore prices go up to a point where they can pay back like over $4.50 per share in dividends and buybacks, well, that could still be very, very attractive. But these next couple of years, even if iron ore prices stay where they're at, I don't think they're looking good. By the way, if you like my work and you want to know what I'm buying or selling with my own money, consider checking out my newsletter. If that sounds interesting to you, go to miningstockmonkey.com/products/VIP or click the link down in the description or the comments below and that'll take you right there. Again, if you're interested in knowing what I'm buying or selling with my own money, miningstockmonkey.com/products/VIP. And now let's talk about some of the risks that Vale might face. So first up is a worldwide recession. If we experience some kind of worldwide recession, well, iron ore prices are likely to come down, copper prices are likely to come down. Their revenue could really get hurt. Now, most years Vale is making a lot of money, but back in 2015, the iron ore prices fell way down and 2015 was a pretty rough year for Vale. If we see something like that today in 2025, it could be tough for Vale to continue paying down its debt, not paying down its debt, just paying the interest on the debt, and also paying those Mariana liabilities and everything else they need to pay. So a worldwide recession is a real risk here. And another risk with Vale is they have these legacy tailings dams, well, from past and current operating mines. And what if we see another dam collapse like we saw Mariana in 2015? That is a big risk for this company. However, they're doing a lot to lower this risk. So back in 2020, they had 35 tailings dams that they considered to be level 1, 2, or 3. So with level 1 being the least risky, level 3 being the most risky. And in 2020, 4 of these were at the highest risk level. So 35 total structures, 4 at the highest risk level. But since then, they've been working to lower this risk. So now, at the end of 2024, this was no longer 35. This number was down to 16. And at the end of 2024, did I say 2025? I meant at the end of 2024. This was at 1. And by the end of 2025, this number should be at 9, and this number should be at 0. So in 1 year from now, they should have 0 tailings dams that are at the highest risk level. So I really like to see that they're investing all this money to lower this risk, because something else happening, like happened with Mariana, would be a disaster for this company. And they need to do everything they can to avoid that. And really spending $5 billion to make this happen is a relatively small investment compared to the potential risk they face. Like when looking at how much they've had to pay for that Mariana disaster and how much they continue to have to pay. So although another tailings dam collapse is a risk, it's a much lower risk now than it was before. In late 2024, Vale reached a final settlement in Brazil to compensate the victims of the Mariana disaster. But 3.8 billion is being sought by plaintiffs in the Netherlands in a court case there, and 56.5 billion is being sought by plaintiffs in a court case in the UK. The UK court case is a lot further along than the Netherlands court case, so we're likely to see some sort of resolution to the UK one first. But this is a gigantic risk because Vale is responsible for paying 50% of any settlement or any award that is given by the courts. Now, BHP is responsible for paying the other 50%, but BHP is a much larger company, so they're going to more easily be able to pay any liabilities that might come from this. If you take this total, that's about $60 billion. Additionally, in addition to Brazil that's being sought by plaintiffs, Vale could be responsible for as much as about $30 billion of that. This makes me want to avoid this investment because I don't feel like I have the knowledge to properly analyze the likelihood that the plaintiffs get another huge settlement or another huge award from the courts. That's my biggest negative on the company, right here. So I would like to wait until at least this UK court case is settled before I invest my money in Vale. Even though they're making a lot of money every year, and even though they pay big dividends and are buying back a lot of shares and has potential to pay huge dividends going forward, especially if the iron ore price goes up. But I don't like it here because I don't like this. If you find my analysis helpful, consider subscribing to the channel, and next you can watch this video I made on EMX royalty, or if you're interested in my paid newsletter and getting access to these videos before they're available to the public, click on this right here.